How would you react if you learned you could own a piece of a skyscraper for less than the cost of a pair of shoes? Right now, someone in your city is receiving monthly rent checks from a massive shopping center, and chances are they've never set foot inside the building. Imagine turning your pocket change into passive income, all from the comfort of your couch. The secret lies in REITs, or real estate investment trusts. REIT investing is surprisingly simple if you know what traps to avoid. Stick around, because in the next few minutes you'll discover how to transform $100 into real estate ownership, demystify the REIT maze, and potentially unlock a stream of income most people never realize is possible. Ready to build your portfolio like the pros without needing a millionaire's bankroll? Let's make something clear. REITs aren't some exotic Wall Street trick. They're designed for mainstream investors. Picture this. You walk into a grocery store, pass a luxury apartment, scroll through your favorite shopping site. All of these places might be owned by a REIT, and pieces of that ownership are bought and sold every day. If you've ever dreamed about owning property, building wealth, and collecting rent, all without loans or landlord headaches, REITs are one of the most powerful vehicles available. Hold up. How can something so simple be overlooked by so many? Maybe it sounds too good to be true, especially when real estate conjures images of down payments, cable installers, and 30-year mortgages. But what if you could skip all the paperwork and still get a slice of the returns? Stick with this, because we're breaking down everything, from the foundation to the penthouse, giving you clarity, confidence, and a real plan to start. Here's the first mind blower. REITs are legally obligated to pay out at least 90% of taxable profits as dividends. Take a breath and let that sink in. While traditional companies may hoard their earnings, REITs operate under a strict rule. If the properties make money, the shareholders get paid. Real estate in a box? Almost. Let's reveal the playbook. First, what is a REIT, really? Imagine if a giant company pooled together funds from thousands of investors, used it to purchase income-generating properties, and then gave everyone a share of the profits. That's a REIT in one line. You're not just buying stocks, you're tapping into physical assets: hospitals, data centers, apartments, shopping malls, even timberlands. Now imagine the security guard at your local office tower unknowingly working for you indirectly. Here's a question. Why would a newcomer pick REITs over buying property directly? Consider the headaches: negotiating prices, signing contracts, hiring plumbers, navigating volatile markets, legal battles, and vacancies. With REITs, you get instant diversification, professional asset management, and liquid shares you can sell with a click. Your $100 could be earning a cut from thousands of tenants across the country without ever unclogging a toilet. Let's pull back the curtain further. That $100 could be spread across multiple properties: skyscrapers, warehouses, cell towers, because most REITs own dozens, sometimes hundreds of sites. If one building floods, another thrives. It's the polar opposite of buying a single rental home and sweating every repair bill. Want proof? Some REITs pay out dividends every quarter, some monthly, creating a rhythm of cash flow that feels much closer to rent collection than stock speculation. Now, not all REITs are alike, so let's walk into the REIT mall. What are you shopping for? There are equity REITs, which own and operate properties. Think apartments, malls, hotels. Then there are mortgage REITs, which lend money to property owners and profit from the interest. This is more like being the bank. Hybrid REITs blend the two. Your choice shapes your income streams and risks. Feeling sophisticated? There are also specialties: data center REITs, healthcare REITs, infrastructure REITs, even timber and farmland REITs. Yes, you can own a piece of the forest just as easily as buying a stock. Here's a twist you won't see in most real estate discussions. REITs are traded on stock exchanges, just like Apple or Tesla. That means you benefit from transparency, strict regulations, daily pricing, and near-instant liquidity. No brokers, escrow agents, or weary realtors. Want in or out? Hit the button and you're done. Compare that with the average 6-month slog to sell a house. If you want flexibility, REITs are unmatched. Now, what about the flip side? Nothing in finance is pure upside. Here's what the wise investor watches for. REITs rely heavily on market conditions. If interest rates spike, property values can wobble, and so can rent payments. If the economy tanks, tenants struggle, and so do dividends. Management matters. A poorly run REIT can sink just as fast as a mismanaged apartment complex. And because REITs pay out most profits, they usually borrow to grow, exposing you to debt risks. The lesson? Pick your REITs like you'd pick a business partner. Here's one more curveball. Taxes. REIT dividends are typically taxed as ordinary income, not at the lower rates reserved for qualified stock dividends. But if you hold REITs in a tax-advantaged account like an IRA or 401k, you can sidestep much of that. Smart investors use this trick to maximize their net returns. So how do you wade into the REIT world with $100? The answer is as simple as opening a brokerage account. Most REIT shares are affordable, often less than $50 a piece. With fractional share investing, even pennies count. You might start by researching leaders, big names like Realty Income, Simon Property Group, or Public Storage, or choose REIT-focused ETFs, which bundle dozens of REITs for instant diversification. At this point, you might be wondering, how do you choose the right REIT? Look for signs of health. Consistent dividend payments, strong property portfolios, solid management teams, and growth in funds from operations, FFO. This last metric replaces earnings per share, giving you a real window into rent collected and expenses paid. Check the debt load, the tenant mix, and the geographic spread. The most resilient REITs survive downturns and thrive when markets rebound. Here's a real-world story. Picture Brad, a newcomer to investing. He puts $100 into an industrial REIT focused on logistics warehouses. Over time, that investment grows, not just from rising property values, but from regular dividends paid out like clockwork. Unlike buying a condo, Brad pays no property tax, does no repairs, and sells out in seconds. Meanwhile, his friend Sally pours $100,000 into a duplex, bankrolls new carpets, hunts for tenants, and still faces vacancy scares. Fast forward a year, Brad's portfolio is liquid and steady. Sally's investment is a roller coaster. This leads to the most crucial comparison: REITs versus direct real estate investing. On the one hand, that feeling of holding a deed, choosing paint colors, and screening tenants is tangible and rewarding. On the other, it's costly, time-consuming, and can be risky. REIT investors trade control for convenience, but often gain diversification, easier access to cash, and fewer sleepless nights. Direct owners can leverage mortgages and sweat equity, but suffer the volatility of local property markets. Let's break down the similarities and differences further. In direct ownership, you pick your assets, control all decisions, and can tap into rising home prices. You also shoulder 100% of the risk: repairs, lawsuits, water damage, market cycles. REIT investors have teams of experts managing portfolios worth billions, using sophisticated software and industry connections to maximize performance. You don't worry about broken boilers or tenant disputes. The REIT handles everything. Here's the shocker. Some REITs outpace physical real estate in long-term returns. Historically, REITs have averaged returns close to 10% annually, rivaling or beating private ownership, especially when counting dividends and growth. Of course, the same market swings that help can also hurt. REIT prices can fall with the broader stock market, sometimes for reasons having nothing to do with the underlying real estate. Now let's talk volatility. REITs tend to swing more than physical property. Stock prices move by the minute, influenced by headlines, global events, and investor sentiment. But what you lose in stability, you gain in flexibility. Need to cash out? REITs make it effortless. For physical property investors, selling involves inspectors, lawyers, and often a lot of patience. You're not just investing in buildings, you're investing in trends. Today's REIT landscape includes industrial giants powered by e-commerce, healthcare facilities riding demographic waves, tech-linked data center REITs, and renewable infrastructure REITs focused on the green energy revolution. You can tilt your portfolio based on predictions. If you expect logistics, healthcare, or tech real estate to boom, there's a REIT for that. Another strategic edge: portfolio integration. REITs offer exposure that's often distinct from the stock market or your bond holdings. During times of inflation, real estate can act as a hedge against rising prices, protecting your purchasing power. Smart investors allocate 5 to 15% of their portfolios to REITs, smoothing out bumps when stocks and bonds falter. Imagine this next scenario. Someone with a high-flying tech job, a mutual fund portfolio, and zero time for the headaches of physical property. For them, REITs are the perfect bridge. Real estate returns, no hands-on work, and assets managed by pros. On the flip side, a hands-on investor hungry for tax breaks and sweat equity might prefer the property ownership route. Still, every strategy has pitfalls. The biggest risk with REITs? Market overexuberance. Sometimes REIT shares are bid up to unsustainable levels, disconnected from the income the properties generate. Savvy investors wait for pullbacks, analyze the numbers, and avoid hype. The best entry points are often during market corrections, when prices disconnect from long-term fundamentals. Here's a toolkit you can use today. Pick your REIT after running a simple checklist. What are the properties? Where are they located? Who are the tenants? Big brands or unstable newcomers? How long are their leases? What's the credit profile of the REIT itself? Dig into annual reports and investor presentations. You don't need an MBA, just curiosity and Google. Let's talk fees. REITs charge for management, property upkeep, and expansion. Most listed REITs keep fees moderate, but private REITs, available only to accredited investors, sometimes charge more, lock up funds for years, and add layers of complexity. For newcomers, listed REITs are simplest, most transparent, and low cost. Another question that always crops up: how do REITs handle recessions? Just like any real estate, some sectors suffer, some thrive. During downturns, retail REITs might see sales fall, but healthcare and apartment REITs often remain steady. Diversification is your shield. Don't put all your eggs in one property type. One of the most misunderstood factors: leverage. REITs often borrow to purchase more assets, boosting returns but also increasing risk. Track the debt-to-equity ratio. A lower number means less risk, higher means more growth but higher volatility. Most strong REITs balance debt smartly, avoiding reckless expansion. Want to know a top strategy the pros use? Automatic reinvestment of REIT dividends. Instead of cashing out quarterly or monthly, opt into DRIP programs, dividend reinvestment plans, turning payouts into new shares. This can supercharge compounding over the years and turn small contributions into sizable accounts. Let's switch gears. What are the latest trends shaking up REIT investing? In recent years, technology-focused REITs, like those owning data centers and cell towers, have exploded alongside digital transformation. Pandemic shocks hit hotels and retail properties, but turbocharged industrial and warehouse REITs. ESG, environmental social governance criteria, mean investors now evaluate how green and sustainable their REIT portfolios are. Newcomers can use websites like Nareit or brokerage research tools to filter options based on yield, growth, risk, and social responsibility. Now, what about buying direct real estate through new platforms like crowdfunding? This lets you own slices of real buildings, but often lacks transparency and liquidity. Most platforms have lockups, higher fees, and less oversight. For maximum flexibility and regulatory clarity, listed REITs win hands down. Remember, no strategy fits everyone. People with deep market knowledge and renovation skills thrive in property ownership. Investors who value simplicity, liquidity, and diversification choose REITs. The key is knowing your strengths, risks, and goals. Picture yourself 1 year from now. You've started with $100, chosen 3 REITs, 1 apartment, 1 industrial, 1 healthcare. You see monthly or quarterly deposits land in your account. You track earnings, tweak investments, and expand your portfolio. Instead of worrying about burst pipes or slow tenants, you focus on growth, compounding, and strategic choices. Your risk is spread widely. Your time is free. Your account is liquid. Real estate, once exclusive and intimidating, is now open to you and a whole new class of investors. REITs have democratized property ownership, delivering passive income, professional management, and portfolio flexibility. If you can buy a cup of coffee, you can own a piece of America's skyline. The next move is yours. Will you continue dreaming about real estate returns or join the millions quietly collecting passive income every month? With REITs, the path is open, the tools are at your fingertips, and the barriers have never been lower. Pull up your brokerage, run your research, and get started. For less than the cost of a few lattes, you can own a slice of the city. If you want true freedom, remember this final principle. The wealthiest investors in history built fortunes brick by brick, property by property. Today, REITs let you do the same. Scaled up, managed by experts, and accessible through your phone. No landlord drama, no repair bills, no locked up capital. Just a well-designed channel for ordinary people to step into the world of real estate investing $1 at a time. So turn that $100 into something extraordinary. Your journey starts now.